Hey, everybody. Thank you so much for joining me. We're going to talk about some stocks today. Before we do, please remember to hit subscribe if you want to keep up with all of my latest investing in personal finance content. And please leave any comments or questions you might have at the end of this video. I would love to hear your thoughts on the stocks I'm going to talk about and would love to answer all your questions. And last but not least, please check out the link in the description for an offer from this video's sponsor, The Motley Fool. So most of my portfolio I would consider forever stocks. I know on my YouTube channel I talk a lot about some of the growthier names in my portfolio and some like high growth names I have my eye on. But the reality is about 80% of my portfolio is invested in what I would consider to be forever stocks. That is stocks that I could see myself holding for decades, stocks that I don't see any big risks of their businesses going under anytime soon. But there are a few in particular that I really just don't worry about. So I want to talk about three of them today. So the first one is Berkshire Hathaway, ticker symbol BRK-A or BRK-B. Most people own the B shares because the A shares are several $100,000 apiece. But this is Warren Buffett's conglomerate. Warren Buffett took over Berkshire Hathaway in 1964. At the time, it was a struggling textile manufacturer. He's pivoted the business. He had no interest in owning a textile manufacturer. He focused on insurance. He bought some insurance companies and started using the premiums generated by his insurance businesses before they were paid out for claims. This is known as the float. He started using the float to invest in stocks, invest in businesses, and the company evolved into a massive conglomerate. Berkshire Hathaway today owns more than 60 subsidiary businesses, including a lot of names that you probably know. You can see the full list on Berkshire Hathaway's website, but just to name a few of the brands Berkshire owns, Geico is its major insurance operation. It also owns some brands that are well known by US consumers like Duracell, the batteries, Fruit of the Loom. It owns the Pampered Chef and dozens more. In addition to all of its subsidiaries, it's built up a stock portfolio that's worth over $300 billion, including a substantial stake in Apple, by far the portfolio's largest investment. It also owns more than 12% of Bank of America. It owns large investments in Coca-Cola, American Express, and a few other companies. All in all, it owns about 4 dozen stocks. So I kind of look at this as a diversified investment portfolio all in one company. Most of Berkshire's businesses are there because of their resilience, no matter what the market's doing. Warren Buffett loves businesses with great economics that aren't terribly recession prone. Think of Geico. No matter how bad the economy gets, people still have to pay their car insurance. A lot of their businesses are handpicked just like that. Duracell, people still need batteries, no matter what the economy is doing. So I don't really worry about Berkshire. What do I expect from Berkshire over the next 30, 40 years, however long I end up owning it? Well, since Warren Buffett took over in 1964, Berkshire Hathaway has delivered 3.6 million% returns to investors. That means if you had invested $1,000 at the time Warren Buffett took over in 1964, your investment would be worth about $36 million today. I don't expect that kind of performance over the next few decades. It's just not possible. The numbers have gotten too big. There's honestly not enough money in the world to support a 3.6 million% gain from this point. However, this is a stock I own because I think it's going to beat the market by a little bit, which over time can add up. If the S&P 500 averages a 10% return over the long run, Berkshire Hathaway might achieve 10 or 11, 12, slightly outpacing the market, which over time makes a big difference in my portfolio and with a lot less volatility. Berkshire is not a volatile stock. It will still move up and down in the short term. It's drawn down by, I think, 50% or more twice in its history, but it's not a terribly volatile stock. It's one that's great to own in tough times, especially like right now. And it's one that I've bought about 10 years ago in my portfolio, and I don't plan on selling a single share of. Number two is a company called Realty Income. Ticker symbol for that is just O. This company actually has a trademark on the name, the Monthly Dividend Company. It pays its dividend in a monthly installment, and it's made more than 600 consecutive monthly dividend payments to its shareholders. Realty Income is a real estate investment trust. They own a portfolio of mostly freestanding retail properties, but specifically designed to be very not prone to recessions and not prone to e-commerce disruption. Most of its retailers fit into one of three categories: either non-discretionary retail, meaning they sell things people need; discount-oriented retail, think like big box stores and warehouse clubs like Costco and BJ's; and companies that are service-based. Companies that sell a service, not a tangible product, are inherently not disruptible by e-commerce. So it has those three kinds of businesses in it. It also uses a net lease structure, which, if you're not familiar, it's a type of commercial lease that essentially has a long initial term, think 10 to 15-year lease term, has built-in rent increases over time, and it requires the tenants to pay property taxes, insurance, and building maintenance. Essentially, all Realty Income does is acquire a property with a high-quality tenant in place and collects a growing income stream over time. This company has performed incredibly well since its 1994 IP or its 1994 NYSE listing. It has delivered annual returns over 15% as a combination of dividends and share price growth. Management has done a great job of capital allocation, and I don't see any reason why this would change. It owns over 10,000 properties today, but there are literally millions of properties in its investable universe that it could go after. So I don't think its growth is done by any means just yet. Number three, last but certainly not least, is Disney. Disney is a stock that is relatively new to my portfolio. I added it when the COVID pandemic first started and the stock price dropped. Um, Disney doesn't really need much of an introduction. It has its theme parks, it has its cruise line, it has its movie studio, it has some other properties that people like ESPN, the ABC networks, big media conglomerate. It has unmatched brand loyalty. What we've seen over the past year or two is that demand for its theme parks, its movies, its products is stronger than ever. Movies are starting to come back in full force. Its cruise line has excellent demand. Its parks have never generated more revenue than they are right now. And add on top of that the success of the Disney Plus streaming platform that was launched right before the pandemic started. They couldn't have timed it better, even if they knew it was coming, because people were just stuck at home and they spent a lot of money on entertainment. Disney achieved its 5-year goals for Disney Plus within the first year. They're investing a lot in content for the service because of its early success. And this is going to be a multi billion dollar high margin revenue stream once it's really built out and mature. I think this is kind of the ultimate combination of, you know, rock solid intellectual property and high demand and a business that's not going anywhere, combined with like the next Netflix. So Disney's a stock that I own. I bought some in both of my children's accounts for them to hold for years and years and years. And it's a company that I don't worry about the future at all. I know they're going to make money. I know they're going to do really well. So to kind of sum this up, it's worth mentioning that none of these are without risk. I don't worry about these stocks, but it's still worth keeping an eye on. There are things that can go wrong. The stock prices can move quite a bit. We saw that with Disney. I mentioned I bought it in the early days of the pandemic when it lost about 50% of its value. Um, these stocks can be volatile over the short term. They tend to be less volatile than the overall market, but that's not always the case. And even though they're stocks that are thought of as relatively boring businesses by a lot of investors, they all have market beating potential over time. I hold all of these and plan to hold them until my retirement and beyond. But that doesn't mean that I think of these as kind of like bonds. I think of them as stocks that can and more than likely will continue to beat the market over the long term and help me build wealth for my own retirement. So hopefully you enjoyed this video. Please click subscribe if you did, and I will see you next time. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.